Warren Buffett is undoubtedly the greatest investor of all time, achieving an average annual return of 20% for Berkshire shareholders since 1965. And as a result, according to the most recent Forbes Billionaire List, today Buffett is the sixth richest man in the world, worth a cool $96 billion. But even Buffett is not perfect, as he too has made many investing mistakes that he of course now regrets. He literally lost billions of dollars in some of his investments, but maybe his most costly mistakes might be investments that he never actually made, and thus, these mistakes don't actually show up in Berkshire's investment returns. But nonetheless, these missed opportunities represent a real cost for Berkshire investors. Opportunity cost. So in today's video, I will discuss which 3 stocks Warren Buffett missed out on and never bought, even though I think he could have understood their business model, and even though the stocks were fairly cheap at some point in time. Hello fellow intelligent investors, my name is René Salman, and before we get to my list of stocks Buffett missed out on, I would love to hear your thoughts. Name one company that you're surprised Buffett doesn't own or never owned. Okay, so today we'll talk about Buffett's most expensive investing mistakes. Buffett has been in the game of investing for multiple decades, and obviously throughout his somewhat lengthy career, he has made many mistakes. For example, just very recently, in his 2020 shareholder letter, Buffett admitted an $11 billion mistake as he was forced to write down nearly $11 billion from Berkshire's bottom line. Here's what he wrote about the aerospace manufacturing company Precision Cast Parts in this letter. I paid too much for the company. No one misled me in any way. I was simply too optimistic about PCC's normalized profit potential. Overpaying for a business, which leads to subpar returns, is considered a so-called mistake of commission. Put in a nutshell, mistakes of commission occur when an investor makes an investment, but for some reason the investment goes wrong. Maybe you overpaid, maybe you overestimated the growth potential of the business, maybe you misjudged management's integrity, and those can be costly mistakes, which is why Buffett is famous for stressing his rule number 1, never lose money, and rule number 2, don't forget rule number 1. But there are other mistakes investors can make too. During the 2004 Berkshire shareholder meeting, Buffett said the following.
Well, the mistakes we made, and we made them, some of them big time, are of 2 kinds. One is when we didn't invest at all in something that we understood that was cheap, maybe because we weren't even working hard enough at looking at the whole list, or because for one reason or another we didn't take action. And the second was starting in on something that could have been a very large investment and not maximizing it. Charlie is a huge believer in the idea that you don't sit around sucking your thumb when something comes along that should be done, that you pour into it, and that's generally what we've tried to do. But there have been times, and it's usually happened when I've started buying something at X and it went up to X plus an eighth or some intolerable amount like that, and I quit or waited for it to come back, and we've missed in some cases billions of dollars of profit because.
So a mistake of omission, in contrast to a mistake of commission, occurs when you fail to act. And arguably Buffett has missed more great investments than he has actually made bad investments. So let's take a look at Buffett's 3 greatest mistakes of omission over the last, say, 10 to 15 years. And I will add 1/4 honorable mention towards the end of the video. But before we get to that actual list, I think we need to consider what the universe of stocks Buffett could have looked at over the past 10 or 15 years actually looks like. To do that, I think we need to consider 3 factors. First of all, the company needs to have a certain market cap, a certain market capitalization. In fact, if a business is too small, and we're speaking of smaller than, say, $50 billion, then any investment Buffett would have made simply wouldn't have moved the needle for Berkshire. Here you also have to keep in mind that Buffett always wants to keep Berkshire's ownership stake in public companies below the 10% threshold due to regulatory reasons. And then secondly, we all know that Buffett places a lot of emphasis on the price he has to pay for assets or business more specifically. So we need to consider whether the stocks that we will look at today were ever available at attractive entry prices. And then maybe finally, Buffett is known for only investing in businesses he actually understands. So we need to consider businesses where Buffett could have predicted with a high degree of certainty that these businesses would be worth more 10 years down the line. Could these stocks possibly have been in Buffett's circle of competence? And all of this brings the universe of stocks Buffett could have looked at or can look at today, maybe down to 100 or maximum 200 publicly traded companies. All right, the first business Buffett missed out on is Google or Alphabet. Google's market cap certainly is and was big enough to move the needle for Berkshire. Google's business was very scalable. And I think if Buffett would have put in the time, he really could have understood Google's core business, Google search. And I would argue that the stock was actually cheap enough on several occasions. And Buffett himself has actually admitted that he probably made a major mistake of omission when it comes to Google. In 2017, he actually admitted that he had early insight into the power of Google's ad business because of Geico, the insurance company and wholly owned subsidiary of Berkshire Hathaway. So he was effectively a client of Google's ad business, and he was aware of the power of these ads and the capital-light nature of Google's business, and maybe also the almost monopolistic power of Google as kind of a gatekeeper of the internet. Here's what Buffett said during a 2017 CNBC interview.
Well, I should have had some insight into, because Geico was a heavy user very early on. So here we saw value in something at that time. I have no idea what we're paying per click now, but we were paying $10 or $11 a click for something that had no cost of goods sold, and we were going to keep doing it. I mean, we could see that. So I should have had more insight into that. Now, whether Bing was going to come along or other people were going to take away the market, that's another question. Whether you had sort of a first user advantage that would prevail. And there is a lot of technology to it. So somebody could have come along with a better technological product, and I would not have had any insights into that. I certainly had insights into the benefit to the user. Just imagine having something every time you just hit a click, the cash register rung somewhere out in California. So it was and is an extraordinary business, and it has some aspects of a natural monopoly. I mean, it's very easy for me when I go to the computer. I've worked with Google before, but I'm looking for information for the annual report. I used to have to mail away to federal agencies or go down to the public library, and now I can get it in 10 seconds. So it's a hugely valuable device, which the other guy pays for. The user of the computer doesn't. The answer is we missed it, and I knew that.
So in that video, he very clearly states that he understood the benefits of Google's ad business, the benefits for its customers, but also the value it provided to the users of Google's search engine. However, he also highlights that he was reluctant because he wasn't 100% convinced that Google's moat would be durable and that competitors could not come up with a similar product or maybe better technology. Interestingly, he said that he still thinks Google is an extraordinary business. Remember, that video was recorded in 2017. So with the benefit of hindsight, one also has to point out that even back in 2017, again, when this interview was conducted, he could have invested in Google and would have enjoyed marvelous returns. In early 2017, the price of a share of Google stock was around $800. And now fast forward to today, and the stock has almost reached a price of $3,000 a share. This represents an annualized return of 31.95%, which is just massive. And if we just consider Google's valuation on an enterprise value to operating income basis, we can see that Alphabet stock was actually fairly cheap for a long period of time, reaching a low point in July 2012. And one might argue that considering the quality of the business and its growth potential even today, the stock might still be fairly attractively priced, as we are speaking right now. Okay, another big company that we cannot find in Buffett's equity portfolio is Amazon. I don't have to tell you that Amazon is one of the greatest stories in business history and that the stock has performed phenomenally over the years. But the interesting question is, could Buffett have understood Amazon's business? Well, I absolutely think he could. Was the company run by a great manager? Again, this is something Buffett places a lot of emphasis on. Well, I think Buffett knows and understands that Jeff Bezos is one of the greatest capital allocators of all time. And Buffett actually said this publicly on multiple occasions. So I think Buffett has a ton of respect for what Bezos has accomplished. Was Amazon stock ever cheap? Well, this is a tough one. Looking back with the benefit of hindsight, the stock of course was indeed always cheap. However, Amazon stock, maybe in contrast to Google, never looked cheap on a PE basis or a price to free cash flow basis, as Amazon was always investing all of its profits quite aggressively back into the business, and in a way hiding its superb profitability. However, one could argue that at least on an enterprise value to revenue basis, Amazon stock was not particularly expensive either, trading below a multiple of 2 for the most part of the last decade. So why did Buffett never invest in Amazon? Well, in a 2017 interview with CNBC, Buffett was asked this exact question, and he admitted that he doesn't really have a good answer to that question and that he probably simply made a mistake. And then he goes on to praise the executive skills of Bezos that he maybe underestimated. Let me just show you a short excerpt from that interview.
It's brilliant. I give him great credit for it.
You have talked extensively over the last several days, even the last several months, about how Jeff Bezos is the best business leader you think we have right now in the United States, about how Amazon is a brilliant company. And now you're talking about how it's one of 5 companies that take no capital to continue to build. How come you don't buy shares of Amazon?
Stupidity. I was impressed with Jeff early. I never thought he could pull off what he did. And what's really, I thought he could pull off something, but on the scale that has happened, it's changed your behavior. It's changed everybody in the office's behavior. And the remarkable thing about Jeff, and everything else, is he's done it in 2 industries almost simultaneously that really don't have that much connection. I've never seen any person develop 2 really important industries at the same time. So at the same time he's shaking up the whole retail world, he's also shaking up the IT world simultaneously, and I take my hat off to him.
But by not buying shares right now, it suggests that you think maybe they're too rich, or is it that you don't understand the company's valuation?
It's a big valuation. It's very hard when you thought about something at 1/10 the price to buy a 10. We do it occasionally, and you're talking now about getting multiples from the hundreds of billions, and I'm not buying any. These are powerful ideas with big potential, and he's executed.
Now, what Buffett also refers to in this clip is a psychological bias that maybe stopped him from investing in Amazon. He said that it's just very, very hard to pay a price that is much higher. He says maybe 10 times higher than the price you could have paid the first time you looked at a stock or this stock. This is called anchoring bias, and even Buffett may suffer from that bias from time to time. Even though Buffett was late to the party in 2017, again, just like with Google, the return of Amazon stock, if you invested in early 2017, actually beats the already spectacular return of Google stock over that 4.5-year period. If you would have ignored that Amazon stock was much, much cheaper in the past and bought on the 1st of January 2017, you would have still enjoyed an annual return of 36.29%. And in addition to that CNBC interview, Buffett is also quoted saying, "Obviously, I should have bought it long ago because I admired it long ago, but I didn't understand the power of the model as it went along. And the price always seemed to more than reflect the power of the model at that time. So it's one I missed big time." Now, I'm not sure if you know it, but interestingly, as of today, Berkshire Hathaway actually owns around 530,000 shares of Amazon. Those shares were bought in 2019, But as Buffett has pointed out, he wasn't able to change his mind on Amazon stock yet. So the shares were not bought by him, but Todd Combs and Ted Weschler, who manage some of Berkshire's capital. And then thirdly, one last major winner over the last decade that Buffett possibly overlooked is Netflix. One could argue that he could have perfectly understood Netflix as a business, as he knows quite a lot about the media industry, having owned or having made multiple investments in newspaper companies or businesses like Disney. And Netflix management team certainly also fits the criteria of Buffett, as Reed Hastings co-founded Netflix in 1995. Today, Netflix is one of the most dominant players in the streaming and entertainment industry, with a vast library of movies and TV series, along with 210 million global subscribers. If you invested $10,000 in Netflix IPO, that investment would now be worth more than $5 million. But of course, at its IPO, Netflix was a completely different business. But even more recently, the stock beat the market handily with a return of more than 500% over the last 5 years. Still, Buffett never actually owned shares of Netflix. And as I said, he probably was capable of understanding the business, but I assume that he thought the business model itself was not that attractive, as content creation is incredibly capital intensive. And as a result, Netflix has only recently turned profitable again. I think moreover, Netflix faces intense competition, as the term streaming war already suggests, and as there are many different companies fighting for people's attention and time. Buffett probably also underestimated the pricing power of Netflix and the early lead the company had among the streaming services. And then finally, maybe on top of that, at least in the most recent years when Netflix dominance has become more and more apparent, the stock never really looked cheap. Businesses trading for a price to revenue multiple close to 10 is just not Buffett's hunting ground. So I can see why Buffett missed out on Netflix. Alright, here's the honorable mention. I think Buffett could have easily invested in Microsoft as well. But we all know about Buffett's tech aversion. He has always made his distaste for technology investments very clear. And moreover, he probably would have been criticized or maybe at least questioned since Buffett is very close friends with Bill Gates. Now, interestingly, or at least I did not know that before doing some research for this video, Buffett actually told David Rubenstein in an interview for Rubenstein's book, How to Lead: Wisdom from the World's Greatest CEOs, Founders and Game Changers, that Buffett did actually invest in Microsoft's IPO. Quote, "I bought 100 shares just to keep track of what this young kid was doing. And this initial investment alone is worth a fortune today." So, Buffett is not perfect. He has missed out on many investments that would have delivered great returns for him and his shareholders. But obviously, it's easy to make these comments with the benefit of hindsight. But I guess maybe one key takeaway from this video is that it's never too late to change your mind, even though it might be incredibly hard mentally to pay more for an asset that was trading for less 1, 5 or 10 years ago. But sometimes that's the right thing to do, as winners keep on winning.